Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll do one question of profit reconciliation statement where we have financial book profit with various items of incomes and expenses which we don't record in cost book, and also we have details of cost book which we are required to use to prepare profit reconciliation statement. Let us read the question. RST Limited has furnished the following information from financial books for the year ended 31st March 2012. Opening stock, clearly it is said finished goods 2500 units. So in cost book it has to be added to cost of production. Raw materials, direct materials, direct wages, direct labor, factory expenses, factory overheads, office and administration expenses, administration overheads, selling and distribution expenses, selling overheads, goodwill written off. This item is recorded in financial book, but it is not recorded in cost book. Loss on sale of investment. Any profit or loss on sale of asset is recorded in financial book, but it is not recorded in cost book. Sale of 47,500 units. Sale of finished goods. Closing stock of finished goods 5,000 units. As per cost book, we are required to deduct this figure from cost of production. Commission received. This is the income which is recorded in financial book, but it is not recorded in cost book. Bad debts recovered. This is the income which is recorded in financial book. It is not recorded in cost book. Net loss. As per financial book, there is net loss of rupees 36,000. The following information is revealed. Revealed means shown from the cost records for the year ended 31st March 2012. Raw material consumption rupees 40 per unit of production. This is direct materials per unit. Direct wages are 70% of direct materials. So direct labor is based on direct materials, that is 70%. Factory overheads are recovered at 50% of direct materials. Administration overheads are taken 20% of works cost. Selling and distribution overheads are recovered at rupees 15 per unit. Selling overheads. Opening stock of finished goods is valued at 101.80 paise per unit. This will be added to cost of production. Closing stock of finished goods is to be valued at cost of production, that is current cost of production per unit. Selling price is recorded at rupees 125 per unit sold. Prepare detailed cost statement showing total cost, per unit cost and profit. And secondly, statement of reconciliation. Prepare detailed cost statement showing total cost, per unit cost and profit. And secondly, statement of reconciliation. We'll have to do one working note to find out units produced. Units sold is equal to opening stock of finished goods plus unit produced minus closing stock of finished goods. Units sold 47,500 units. Opening stock of finished goods 2,500 units. Closing stock of finished goods 5,000 units. So units produced are 50,000 units. That is what we got from this working note. In cost sheet, first item is direct materials. Raw material consumption is rupees 40 per unit of production. So it will be rupees 20 lakhs and per unit direct material rupees 40. Direct wages 70% of direct materials. So it will be 70% of 20 lakhs. So it will be 14 lakhs per unit rupees 28. So we got prime cost 34 lakhs and per unit it is rupees 68. To this we are required to add factory overheads. Factory overheads are recovered 50% of direct materials. %50 of direct material, it will be 10 lakhs. Per unit it will be 20 rupees. So works cost we had 44 lakhs. Per unit is rupees 88. Administrative overheads are taken 20% of works cost. %20 of works cost. So we got cost of production 52 lakh 80,000. Per unit it is 105 rupees 60 paise. There is opening stock of finished goods 2,500 units, and here they have said opening stock of finished goods is valued at 101.80 paise per unit. Less closing stock of finished goods, number of units 5,000 units. Here they have said closing stock of finished goods is to be valued at cost of production. Cost of production per unit, that is current cost per unit 105 rupees 60 paise. So we got cost of goods sold 47,500 units sold 50 lakh 6,500. Per unit it comes to 105 rupees 40 paise. To this we are going to add selling and distribution overheads are recovered 15 per unit. So total cost comes to 57 lakh 19,000. Per unit it is 120.40. To this we are required to add profit. As per cost book, selling price is given rupees 125. So we can get total amount of sales 59,37,500. Per unit profit is 4 rupees 60 paise. So this is profit as per cost book, whereas profit and loss account is showing loss. So we are required to prepare a working note to find out the reasons for difference in profit as per cost book and loss as per financial book. Our profit reconciliation statement will start with cost book. Therefore, I have taken first column as what? Cost book values. In second column, financial book values, and third column is of difference to fix the sign plus and minus. Direct materials as per financial book, it is 20,80,000. As per cost sheet, it is 20 lakhs. Opening stock of finished goods 2,50,000. As per cost book, opening stock of finished goods 2,54,500. Direct labor as per financial book 15,15,000. As per cost book, direct labor is 14 lakhs. As per financial book, factory overheads 10,18,000. As per cost sheet, factory overheads are 10 lakhs. As per profit and loss account, office overheads are 8,45,000. As per cost sheet, it is 8,80,000. Selling and distribution expenses as per profit and loss account 7 lakhs. As per cost sheet, selling and distribution expenses 7,12,500. Goodwill return of 60,000. This is recorded only in financial book. Loss on sale of investment 1 lakh. This is recorded only in financial book. Let us consider items of income. Sales as per financial book 59,85,000. Sales as per cost book 59,37,500. Closing stock 5 lakhs. As per cost sheet, closing stock valued at 5,28,000. Commission received 35,000. Bad debts recovered 12,000. We have recorded all the items of difference from first amount column. Now we'll deduct the values of second amount column. Continue. In case of income, we are required to reverse the sign. It is minus 47,500, but we'll take plus. It is plus 28,000, but we'll take minus. Minus 35,000, but we'll take plus. Minus 12,000, but we'll take plus. Now we can proceed to prepare profit reconciliation statement. We'll be starting profit reconciliation statement with profit as per cost book. Cost book profit is 2,18,500. Now we'll be adding the items. Opening stock of finished goods plus 4,500. Office and administration overheads plus 35,000. Selling and distribution expenses plus 12,500. Sales 47,500. Commission received plus 35,000. Bad debts recovered plus 12,000. We have added all the items which are having plus sign. Now let us consider sign with negative, that is negative numbers. Direct materials 80,000. Direct labor minus 1,15,000. Factory overheads minus 18,000. Goodwill written off minus 60,000. Loss on sale of investment minus 1 lakh. Closing stock minus 28,000. We have started with profit as per cost book 2,18,500. We'll be adding all these values having plus sign. It comes to 1,46,500. This will be added to 2,18,500. It comes to 3,65,000. Now we'll be adding this negative values. It comes to minus 4,01,000. This will be deducted from rupees 3,65,000. So it comes minus 36,000. That is loss as per financial book. We can refer to question. Net loss as per financial book is given 36,000. Our profit reconciliation statement is also showing this loss 36,000. This is how we have prepared profit reconciliation statement by preparation of detailed cost statement and referring to the profit and loss account. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.